that. So in this volatile market, it is better to identify companies that are migrating from good to great. That's the advice coming in from Motilal Oswal. Joining us now is the author of that report, Ravi Shenoy, the Vice President, Midcaps Research at Motilal Oswal Securities. Ravi, hi, good afternoon, and thanks for joining us. Since you track the midcap space very closely, do you expect the same kind of returns to get generated from midcaps from now, say, for the next 12 months compared to what we've seen in the past 1 year?
No, Sonia, I think on the mid-cap side, one would have to be very, very selective and be in good companies if one is looking at decent kind of returns. From a valuation perspective, valuation re-rating has already been done, and it would be earnings which would drive shareholder returns from these levels. So selective there. And what we are also advising clients is to look for frontline companies where valuations are a mismatch, which is where the good to great report that we have put out would help investors.
Okay, Ravi, hi, good afternoon. So let's talk about some of these names. The name that stands out for me is United Spirits. At the current price, it's seen a bit of a correction. What's the story now, and what would be your price target?
Well, from a valuation perspective, we've seen United Spirits come off quite a bit, right? And from a business perspective, we've had a management change in the company. That's great from a investor perspective. You now have a MNC management there, which wants to clean up the books, and the cleanup has been in process for some time now. What we are looking at is the numbers should start panning out as we expect them over maybe the next 2 or 3 years, but we are looking at the stock more from a 10-year kind of a perspective. From a target perspective, we currently have a target of about 40 to 50 on this particular stock, which offers a pretty healthy upside from the current levels.
Okay. Well, the other stock that you're recommending is Zee Entertainment. That one had a great quarter gone by in terms of ad revenue growth, but the stock has also moved up, from 300 to 400 in the last 4 months or so. What kind of an upside do you see for Zee Entertainment, say, for the next 1 to 2 years? And what are the key triggers now?
Zee for us is more a structural change story, wherein digitization is something that is helping companies such as Zee to gain more of the revenues that their customers have been paying to the channel. There have been leakages in the channel which digitization is expected to plug. From a target perspective, we have a target of about 475 on this particular stock. From a triggers perspective, we expect digitization to add to earnings growth, clearly because subscription revenues are expected to rise significantly from these levels. So while historically Zee has been dependent upon advertising to drive its revenue and profitability, now you have another leg in terms of subscription which will add to revenue as well as profitability growth.
Okay, your target on Eicher Motors is quite eye-popping actually, 24,137. Do you think it's it's not expensive according to you, and at current valuations? I mean, what is the trigger for the stock to go up to 24,000?
Eicher as a stock has been a personal favorite because I have a report out on Eicher at about 3,000 odd levels. It was a great discovery, and it's moved beyond what we expected it to. That's also because the growth on the Royal Enfield side has been far stronger than what we imagined or well beyond our expectations 5 years ago. From a growth perspective, we still continue to expect this company to grow its earnings by 35% plus. So we think there are levers from a stock perspective. Valuations, yes, valuations if you were to look at it on a historical basis are expensive, but we believe that there will be a set of companies that will continue to remain expensive and even probably get even more expensive from these levels. iShares for us is more a lifestyle play, and we could see the stock move up even significantly from the current levels. So our target here could prove to be, let's say, very, very conservative.
Oh wow, okay, that's an interesting point. 24,000 a conservative target, but what about Maruti? You have a target price of 5,290 there, so that's a big upside to the current market price. I wanted to understand from you, how much is their contribution, or rather how much is their exposure to the yen currently, and how much have they brought it down by?
Yen is from a raw material import perspective. Maruti largely as well as from a royalty perspective. So the royalty angle now has got capped with royalty now payable in rupee. But the imports still continue to a small extent to be in yen. But our positivism on Maruti is more from a fundamental perspective, because India continues to be under-penetrated on the four-wheeler mobility side. We expect car sales to continue to grow in double digits, and Maruti, as the largest player in this space, would continue to grow at least industry standards, if not higher. There are other competitors who brought in newer models. That's a challenge for Maruti. Maruti has taken that challenge pretty well. In fact, Maruti has taken the challenge now to its competitors. The Nexa stores are actually a challenge for the Hondas and the Hyundais of the world. And we await success on that particular front, because Maruti has been known for value for money, and any success in the higher end space is something that will only add to valuations from these levels. From a driver's perspective, we also have lower commodity prices, which they have retained with themselves. That's something that will add to profitability. So here again you have a company which will continue to grow earnings by about 25% plus.
Okay, we normally describe FMCG as boring, slow moving, but Britannia clearly has been the most entertaining stock for the bulls for last 2 years or so. From 400 all the way up to 3,000, it's been one-way journey. And do you think that after the current correction, is it still a good buy at current levels?
We feel that it's a great buy at these levels, and there's an opportunity for anybody who's missed out in the previous rallies. So if you don't have Britannia in your portfolio, it makes sense to take at least a small exposure there. The re-rating on account of, let's say, earnings growth or expected earnings growth has partly happened, and from here on investors would have to wait and be patient and expect returns in line with earnings. Having said that, earnings growth for Britannia will continue to be in the 25-30% kind of range, despite it being a boring industry. We've had some amount of excitement being brought in here by Britannia. You've had premiumization of a segment which was dominated by the glucose biscuits. So a 5 rupee biscuit today has become a 50 rupee biscuit packet, and this premiumization is something that will keep adding to the profitability of Britannia. Other than biscuits, the dairy segment also looks pretty interesting from a Britannia perspective, and if things do pan out for Britannia on that front, you would have one more leg to carry Britannia up ahead.
Okay, that's interesting. What's your target price on Britannia?
Britannia, just give me a moment there.
I think I have it in your report. You have a target price of 3,600. All right, I got that. Ravi, also you have a buy call on IndusInd Bank. What's interesting is you have a 4-digit target price on that one, 1140, but it barely managed to get there. You know, its 52-week high was also just about 1,000 rupees, and it started sliding from there. There's something that's keeping the stock from getting to those 4-digit levels. What could that be? And what do you see the trajectory of the stock look like from here on?
From an earnings perspective, this is an industry that's likely to grow at a strong pace. we've seen some amount of slowdown in the industry per se. As the economy picks up, we expect credit to pick up, and private players such as IndusInd are expected to take away market share from PSUs there because of the innovative ways of getting in customers. So you have an IndusInd who's offering the ATM withdrawals in various denominations, which was industry first, so to say, and that's something that is likely to continue to drive IndusInd Bank. From a near-term perspective, of course, after you run up so sharply, one should expect some kind of a breather, and in an industry where most other stocks haven't been performing as well, if you run up, then the valuation gap that you have with the leaders tends to get filled up more. So IndusInd Bank probably would now have to perform better than the industry, or continue to perform better than the industry, for it to outperform from these levels.
Okay, the stock where you have the most aggressive price target is IDFC. Of course, the jury is out on what happens when it becomes the bank. There are equal number of bulls and bears on IDFC, but what's driving this kind of aggressive price target on IDFC?
One is the value unlocking that we expect from shareholders getting the bank share. So that will drive the majority of the upside in the stock. We're looking at a bank with almost 100 rupees as book value. If even when we're to be conservative and give it a 1.5, 2 times book, and 1.5 would be, I think, the base case here. 2x would be the average case here. At 1.5x, you would have a 150 rupee target just for the bank there. At 2x, one is talking about 200 odd rupees of target price just for the bank shares, and you're getting everything else almost free there.
Okay.
So value unlocking, which is keeping us excited on IDFC. Plus, once you become a bank, your cost of funding moves down significantly, and you of course have a large infrastructure book, and you have a government in place which is very much focused on infrastructure there. So in fact, we have 2 companies in this report which we've been recommending to investors as a barbell strategy. On one end you have a IDFC, which is a financer. On the other end you have a L&T, which is a executor of infrastructure projects.
Okay. Last question from me. Oil marketing companies as a theme played out in the first half of the year. The last 2 or 3 months, we have seen quite a bit of correction in some of these names. So A, why are you bullish on IOC, and B, why IOC over, say, BPCL and HPCL?
Okay. We like all 3 of the names there. And on the oil marketing part, our feeling is that the move that we've seen in the past is just the trailer, and in terms of earnings, in terms of cash flow, the best is yet to come there, because today on marketing you are earning good amount of margins, and as you earn more on marketing, you will get rebranded in the market as a branded player. And these are companies that did not even have valuations equivalent to their replacement cost till some time back. Now that has been corrected, but these are even today the largest brand plays in India. They are not being priced accordingly. So we still think that there is scope to grow in terms of valuations there. Earnings may not grow as much, but you will have control over your own cash flows, and that's something that is likely to lead to further re-rating in case of oil marketing companies. Why IOC? IOC has the largest network in India. It is the largest refiner in India. So you have control over your fuel supply. You have control over the pumps, which gives you access to customers, which is why the preference for IOC over a BPCL or a HPCL there.
Okay, that was a very interesting discussion that we had on your report and your stocks. But before we let you go, just one stock out of your report which has been a big buzzer today, IDBI Bank. It's up almost 17% now on news that the government is working out of some ways to give it operational freedom, maybe create an Axis Bank-like structure. How would you be positioned on a stock like IDBI Bank?
Sorry, Sonia, we don't have active view on IDBI, so I wouldn't want to give out any comments on this particular stock. You'll have to excuse me there.
All right, that's fine. We've discussed many stocks with you in any case, but thank you so much for sharing your thoughts on your report and giving us the good to great theme in a volatile market like this. That's the word coming in.